Hi, this is G-Man Trading Community. And my friend, we have come from far. We are in CFD trading. We have learned the history of CFD. We learned where it came from, who started it, and where the game changed. And we can refresh our mind. When it comes to CFD trading, we saw that it started with the stock market, which introduced the word CFD, which was contract for difference. And we knew contract were used to trade stocks because one contract stands for 2,000 shares. And then they could measure the distance, and then they could calculate and multiply with the contract. Then they could see how much someone could pay or someone could get paid. Then the game changed when it came to banks, because the banks used the same model as the Bretton Woods collapse, whereby the banks so that after the Bretton Woods collapse, now the currencies could move freely or float freely. The banks which are in those industry, they had to come with a way of counting movement, and they could set the amount of money that could be traded within themselves. As we remember, this system wasn't for us as retail traders, and the banks used only whole standard units. Then a lot of another category of people spotted an opportunity called the retail brokers. They came with a system whereby they introduced another category of traders, which were the mini lots and the micro lots. And then with the same system that was used by the bank to count movement, which they used pips and they set an amount of lots. Then the broker, they came with using the base 10 power. They could divide the lots with by 10, and they could add a category of traders. Then after that, we have learned how to combine lots and pips, and we saw the magic it can do. But with all that, we remember that the amount of money that was needed in the market was still much, because the last categories was micro lot, and a micro lot of $100,000 was 1,000. And then we saw that a lot of people could be left outside because that was a lot of money. Now the retail brokers had to come with another mechanism called leverage, which could open doors for retail traders. It looked like a loan, which they used a ratio. They could multiply your money with the leverage that they offer, and then your money could meet the requirement needed in the market to trade, which is 1,000 plus. So if the broker is offering maybe 1:500, it's just 500 multiplied by your deposit, and you see which category you are. So if you have $100, you multiply by 500, you can see you have 50,000. So 50,000, you are in a category of mini lots. So you have 5 mini lots. So you can open a position of 1 mini lot, because we said you can't open the full size because the broker is cutting some share, some commission and swap fee, and you need even a room for your position to go, whether in negative, because like we said, this is like betting, whereby you have to choose direction. It's like a game of chances. Even if you do your own analysis, you will have to make a decision to buy or sell, and the outcome of the market, it is not based on your own analysis. You are not the one who controls the market. So the reason now you could manage your trade, you can open even with the power of 50,000, you can open 1 mini lot. So we have seen that the bigger the leverage, the bigger room for you to make mistake, which is very, very good, and you don't need a lot of big deposit for you to engage in the market. And the lower the leverage, you need a lot of money, and when your position goes against you just for a particular distance, the broker can close down your position for them to protect themselves, because of margin calls and the charges that they charge in their systems. So, and now I want us to look at the best broker, because now we have seen a broker is mostly involved because they are the one which have come up with all these systems, and we can now see how to find a good broker, how they started. We can start up from a little history. My friend, what don't you know now? Imagine, you can invest, you can trade on price difference. This path, you can tell its story. How CFD started like this. It started with stocks, but later took by the banks, which helped to come up with a way of counting price movement in pips and set amount categories in lots. Now you know how to count pips together with lots. You know how to use lots sizes to execute trade position. Of course, we know that lots are the one which are used to execute trade position, because now you can predict how far the market will go. That's the part of waiting, but the part that is instant is the amount that you're willing to buy in the market. So you still know you can engage the market with the power of leverage with a very little capital, as low as $10. Today I want us to think of the bridge to the market, from the spot market or the real market to the CFD market, and the bridge is retail brokers. Now these are what we want to look at. When you are in the spot market, which is the real market, you still need a broker, and in the CFD trading you still need a broker, and these brokers in the CFD are called retail brokers. So retail forex broker started because of technology plus market structure change, allowing ordinary people to access a market that was previously only for banks. You can see, because of technology, now that's where the retail forex came, and the market structure change, and the ordinary people to access the market that was previously only for the banks. This was only for the banks before retail brokers. In 1970s and 1990s, forex trading was only for big banks, central banks, large corporations, hedge funds. At that time, trades happened through phone call, interbank networks like Reuters Dealing or EBS. Minimum trading size were huge, millions of dollars, because these corporations are very big. They call large corporations. We have central bank, we have big banks. So those are the ones who are originally using this system of trading forex. We were nowhere to be found until the retail brokers came to change the industry. An ordinary person could not trade. So when the internet started spreading and became common mid-1990s, price could be delivered to people at home. Now things have started looking somehow promising, and now the prices were delivered homes through emails. You see, you could have a catalog of all companies, all the money exchange delivered at home. Order could be sent electronically. Now trading platforms became possible. This opens door for new type of business, the retail brokers. And the first generation of retail brokers started around 1996 to 2000. This now people spotted an opportunity of the market movement. How can we come with a way that some people can be predicting market direction and after predicting market direction, then they could benefit from the direction they pick. If they were light, they make money. If they were long, they lose money. So they did that something smart, that created small account like mini lots, which we have been talking about, micro lots, and then here they introduce something. You are now, it was possible for you to trade with event or with $10 with the help of leverage. High leverages of 1:100, 1 to 200 is to 1, 500 is to 1, 1000 is to 1. So these are type of leverages which were introduced by the retail brokers. So this allowed ordinary people to trade what bank traded. The system are the same. What moves in the spot market is the same. The only difference is that me and you, we are taking sides on each other. So if I buy, you sell. If you sell, I buy. So that when there is imbalance, if the market goes on my direction, I'm in profit. If you are in goes in your direction in profit, and I'm in loss. So these early brokers built their own platform, but they were slow, expensive, and hard to use. Of course, we can understand, because those are 1990s, which now the internet is booming. So, but they introduced a way to for people to trade, but the system are slow and more expensive and hard to use. Example of early pioneers. The early pioneers are the FXCM, which came in 1990. We have Rwanda, which came in 1996. IG, which is Forex, added in 2000. These are the early pioneers of the retail traders. But these were not enough with the market demand that was to come in the world. So then a big shift and a game changer came. The MT4 launched in 2005. MetaTrader 4, which was launched in 2005. It opens a lot of opportunity. Let's go on and see. When the MT5 came in 2005 and make the end of house trading, which was so manipulative, retail brokers exploded, because for brokers, the MT4 or MetaTrader 5 servers were cheap, easy to install, easy to manage traders, and could set spreads and could learn automatically. Now you can see, now these are the early pioneers. They have slow systems, very expensive, and when the shift came, when the MetaTrader 5 came, it helped so much, because it ended something called house trading. House trading is whereby the same broker is the one which is holding all the cards. It's now a fair ground. So if they could manipulate your position, it's very, very easy, which they were able to do that. And you see that there is something called comfort which comes if you are the only one offering something. Then there is a comfort that comes later, and that's what they did. But with the comfort and the cry of people, there's always people who spot an opportunity to bring something called some sort of an equilibrium. People could now feel something somehow safer. Now the MT5 came to solve all that. They were so fast, they were cheap, even when it comes to open position. Now you can open position with about 100 a whole standard unit for $3. Imagine. And they were so easy, and easy to install. You just download and you just launch the application, and it lands in your computer very, very fast, easy to manage trades. So you are able to even to open a position. The system are not slow, because they are not done in-house. So because the brokers could manipulate their system for the trades to stay when you close a position. It takes too long until when now your profit has gone. That's when you see your position is closing. So they had faster execution. If you spot an opportunity, you open a position, it is opening very fast. And then you could set spreads, meaning that you can open a position with a zero spread and pay maybe commission, or you open a position with a standard account whereby the spreads includes the amount that you could maybe have paid in commission, so you don't need to pay commission because now you are being offered a little bit more spread, and that we'll see that later. So, and then you could learn trades automatically. Let's go on and you'll see how that could happen. For traders, there was benefits. Charts, something that you could not get. Charts is like data. So they had candlestick, line charts. Now you could track price and repetitive charts and candlestick patterns. So you have now to see the price data. If it is a Euro USD pair, you could see data, previous data of that pair, and you could now be able to predict the future of that particular pair because you have data. You can spot out some repeating patterns. You could see maybe flags. You could see head and shoulders, which were people were able now to spot something like that. You could see falling wedges, rising wedges, a lot of things, and you could see repetitive candlestick patterns, which maybe you see pin bars, you see engulfing, you see Malibuzu, a lot of candlestick pattern because you have the charts. You can see the data of a particular pair, how it has been behaving in the global financial market. So now another thing is the indicators. This would help to track the start of a new movement. Now these indicators, they do help traders to trade by maybe for spotting the new movement of a particular pair. You could see now the pair maybe it would start to rally at this point and you could take your chances. So now when the market is active or see orders, you could be able now to see orders, or when the market is active, you know in the market there is this time that the market is not active. So for you to know, you need an indicator. You need to draw some support and resistance. If the market is in a range, you know that is that market is not moving, something like that. And those are the indicators which came to help through the MetaTrader 4. So another thing is expert advisors, robots. Something was new here. Another banger, MLQ4, had an editor. You could create your own strategy of trading. I mean, write a code on how you trade, put risk management, trade execution, then compile. Then you rent VPS, virtual private server, monthly install. So this changed everything. Within 2 to 3 years, hundreds of retail brokers opened worldwide because of MT4 made it possible. So liquidity providers made it even easier to get rid of dealing desk brokers. Now a lot of things happen. Within 2 to 3 years, many things changed. They pop up a lot of brokers now because of MT4. Then came another school of people which are called the liquidity providers, which came to help the market so much to get rid of dealing desk broker. Dealing desk brokers is when I said that if you open a position, there's someone else supposed to take your position against your position, to be against your position, because this is not the real market. Because where could your profit come from? Where could your money be generated from? So It means that if I open a position, there's someone else supposed to take my opposite direction of my position, so that they, when I'm in profit, is in loss, he or she in loss, or when I'm in loss, someone else is in profit. So as the brokers were coming, they introduced something called liquidity provider. They could link up with the big banks, which could accept to be liquidity providers. Liquidity providers are a lot of money, whereby if I open a position, it's thrown in the market and it is competing with the other big traders or liquidity pool. So when I'm in profit, they are them to pay me, and when I'm in loss, I'm the one to pay them. But when the broker is against you, there's a lot of conflict of interest, because they can overhike something called spread, which could lead to margin call, like we said. A margin call, which is the amount that the broker could close your position, because it is seeing that you are heading into a very, very big loss, which could damage them, and they could wide up the spreads so that they damage you. So but with the liquidity providers, that can't happen, because they own a lot of money. They have billions and billions of money. So you need a broker that has a system whereby they connect with the liquidity providers. So what they benefit from is only commissions and swap fee. So brokers connected to banks are prime brokers, ECN networks. So these are the main liquidity providers. You can be, the broker can have banks, prime brokers, or ECN. Prime brokers, these are big traders with a lot of money, so they can't complain when when the money is needed. If you are in profit and you want your money, they will pay you directly. But if it is a broker, you can see they introduce another hooky rules which were not there, and they say that you have violated some particular rules, so that they can steal from you. But with the liquidity provider, that is not possible. They can't do that. So let's go on. This allows them to offer tight spreads because of liquidity providers and 24-hour trading hours. Many symbols came because system was the same. Many symbols came because system was the same. Simple, pips and lots, and contract is equals to lots, and price difference is equals to pips, which we learned this. And then it opens. Remember, this was for forex. Then it opened this, you could remember when we were investing, this was in the category of commodities. Gold, you can trade indices, you can trade oil, you can trade crypto. Now, because we have a system of counting movement and we have lots, so this system was simpler, was very, very simple. Now you can, today as we talk, you can trade all these using this system. So now anyone with $10 could start trading. Retail trading became global by the year 2008 to date. After the 2008 financial crisis, forex became popular. More people learned about it. Competition grew, regulation increased, platform improved to D trader, C trader, and MT4 stayed dominant because it was very simple and it was the starter. But later it came C trader and D trader. So you can see how MetaTrader 4 came to change the industry. It came to add a lot of brokers. Now you can have a broker of your choice. And you can see the benefits that came with the MT4. And now you can choose even your broker the way you want. You can trade anything, and it came very, very simple. And today retail brokers exist because Technology made trading accessible. Platforms like MT4, now we have MT5, if you know, reduced cost. Liquidity providers handle big orders. Like if you have a big order, the broker doesn't have to manipulate the system so that they can steal your money. Now they can throw your order into the liquidity pool, and when you make a lot of money, it will come from the liquidity pool, and they will benefit from commissions which are generated in your trade position and the swap fees. So people want to trade from home. Now it's very, very simple. Things are done in home. You don't have a trading floor to go and trade, and that's how simple it became. So my friend, now you can see how far we have come. Now the system treats you like a professional. The only thing you need was a bridge to the market, which was the retail brokers. They came, MetaTrader 4 and 5 came to smooth the field. Now you see how the retail brokers helped, and we can see they have done a lot of job. They brought us from the big banks. They introduced mini lots, micro lots. They later introduced leverage. After introducing leverage, now they have introduced some systems which came through MT4, could help to track down the price data, offer indicators. You could have now an editor whereby you can write down your how you think about the market, your strategy. Then you could load it as a robot in the market. It could do what you could do when you are on the screen. You pay a VPS, which is a virtual private server, and then the broker, the robot could do what you could do if you were there. So let's go to the next lesson, which could be now vetting a very good retail broker. But because you know every door that is open, there's thieves that are people are not willing to do the right thing, and they will come and try to scam a lot of people. So let's go on and consider subscribing, liking, and ask a question in the comment section. Thank you.